Hello, professional colleagues, friends, associates, students, and practitioners of our noble Institute of Chartered Accountants of Nigeria, ICAN. I welcome you all to this edition of ICAN on Air Enlightenment Program. Today, we examine the subject, approaches to SME and entrepreneurship. Approaches to SME and entrepreneurship in business valuation by our professional colleagues. It is trite knowledge that valuation of small and medium-sized entities that we call SMEs can be a significant challenge. Valuation standards and business practices are usually founded on large enterprises cases, and therefore, recognized methods need to be adapted for valuing SMEs. Joining us on the question and answer segment of the program to delve deeper insights to the subject is Uchenna Ejiofor, ACA, ACCA, ACS. His passion for personnel development and training earned him the sobriquet relevant lecturer. He is a data scientist from the prestigious University of Texas at Austin in the USA, and is currently the finance manager at InView Technology Limited, an IT company specialized in software development and integration. More to unveil on our esteemed guests very shortly on this program. Also, we shall be letting you into our ICAN diary of events. What is ICAN doing now, tomorrow, and in the short term? Give some few announcements. We do some adverts. Please stay connected. We, and by that, welcoming my co-anchor, Sheso Okunade. Both of us will be back with you very shortly. The subject, approaches to SME and entrepreneurship business. Valuation by professional accountants. Looking at closing the gaps. Sheson, please join me to welcome our guest, Uchenna Ejiofor.
Good evening, my main anchor, Mr. Akin Fatuke, and to my wonderful brother and friend, Uchenna Ejiofor, ACA, ACCA, and ACS. You're welcome to this interactive and wonderful, insightful time. And to our viewers, our professional colleagues, students, friends of the Institute, we are here today. And we will be firing on a double cylinder with our guests today. Promise you to be an insightful time.
You can
Thank
say
you
that
very much.
again. So, Uchenna Ejiofor, ACCA, ACA, ACS, you are welcome to ICAN on Air.
Thank you very much. It's nice being here.
And I'm going to start by firing so that we can put things in perspective and looking at this subject. I'd like us to frame it so that our online viewers can be better appraised on what to expect. And so I want us to look at SME and entrepreneurs in Nigeria. Is it possible? Yes. Can you give an overview of their contribution so far? And what do you foresee?
Thank you for that question. Looking at SME, one of the first challenges you talk about in trying to cap or define or give an overview of SME is trying to look at the definition. Generally, there's no standard definition for SME, apart from the fact that we place them based on threshold, meaning we classify SMEs into micro, small, and medium, looking at it from the turnover point of view, looking at it from their net assets and the number of employees that they have. So those are basically how we try to categorize SMEs. We have the micro, the small, the medium, and this differs across climes. So using the BOI, that's the Bank of Industry classification, it means that if you have less than 10 staff, 10 employees, okay, and a turnover of below 5 million, we can say, okay, this is a micro. And if you go beyond that, between 11 to 50, we say, okay, this is a small business, and anything above 50, we say this is to 200. We're now looking at a medium-sized business. But now that's not the issue. You asked about the contribution they have. Generally, in global economics, you cannot take away the contribution, the immense contribution of SMEs to global economies. Number one, in terms of revenue, in terms of employment, in terms of their development, they have done so much. I want to rely on the current report done by PwC, which they call the MSME survey report. Now, that report reviewed a lot. One of the major revelations it brought is that SMEs for the past 5 years have contributed to about 50%, 49% of Nigeria's GDP. 48 to 50% of the GDP. Now, it goes also further to tell us that SMEs if you look at the number of businesses now, SMEs have close to 99% of businesses, which means if you bring the whole businesses in Nigeria, they have close to 98%. That means we only have 2% based on that report. And then looking at employment, they're giving us over 60, 70% of employment. For sure, they are doing very, very well. But the question is, can they do more? Yes, they can really do more. Okay, that report also shows the major challenges that SMEs are facing. Now, what are those major challenges that SMEs are facing? Now, the ranking based on their chart was access to finance. Okay, now if you look at access to finance, was 22%. Then they also went to the issue of their workforce, the skilled workforce that they require, which was about 7% and all that. So if you look at all these, SMEs are doing very, very well. But can they do better? Yes, they can do better. And I feel with the right things in place and the right education and the right factors as given by that report, SMEs can do better. They are doing well, but they can do better. That's my own opinion. Thank you very much.
Thank you very much, Joe. For if I can pick it, we can see that entrepreneurship is one of the strategic things. And I want to take a lead from our 57 president. It seems to be one of our cardinal point, even for our members, to make sure that it's not just about debit and credit alone, but we can talk more about entrepreneurship. And this will lead me to this question. Recently, there was increase in demand for financing of SMEs, which brings about the issue of valuation of small businesses. I just want us to give us an holistic view of what valuation is all about when it relates to SME.
Well, that's that's a very good question. I want to say thank you for that question. What is valuation? Now, before I go to that your question, we're looking at SMEs. Now, from this report, let's look at Nigeria. If you look at SMEs in Nigeria, 73%, still relying on that report, okay, which anybody can lay hands upon. 73% of our SMEs are sole proprietorship business, one-man owned business, 73%. Okay, now the 13%, close to 13-14% of our SMEs are private businesses, that's private limited companies. Then partnership has like 6%. Where am I going? If you have 73% of your business being owned by one person, that's one-man businesses, sole proprietorship businesses, automatically there becomes a need to look at how well can we help these people. And that brings the issue of valuation. Okay, reports and surveys have shown, okay, that valuation is simply the process. I repeat, valuation is simply the process or procedures of determining the economic or financial value of a company. I'm kicking on that thing, the process, okay, because I'm building up something. Okay, now why do I say it's a process? Now, valuation has to do with the incremental process of building up information. You know, I started with saying valuation is a process. And now I'm saying valuation is the incremental process of building up information required to understand the factors that drive the future value of a company. So when you talk about valuation, you are looking at how somebody will say you're looking at the prophecy or prophesying about how the future of a business, what will somebody enjoy if it becomes part of this business? That's what valuation is all about. Now, there's also a debate on if valuation is an art or a science. Now, it is both. Why? Valuation has to do with following standard principles, which qualifies it as a science, and also valuation has to do with innovation, you know, subjective inputs that you're going to use in trying to determine what the actual value of an organization is. So when you talk about valuation, in my own opinion, right, my own definition now, valuation is the whole process of designing a model that helps the owner of an organization understand the value drivers in that organization and what values they ought to bring or are bringing or will bring in the nearest future.
Thank you very much for that holistic view of what valuation is all about. Based on what you've just said, let me take you up on this. You said valuation is actually a process. You went further to talk about considering it as an art or science. Let me ask this question. If you're saying it's an art, it's a science, it's an incremental process, when and why should valuation be considered for small businesses?
Thank you very much. Small businesses, why should they value them? You know, in reality, if you look at it today, small businesses don't see valuation as an important concept. Why? Number one of the reasons why small businesses don't, they believe theoretically that valuation should only be done at some certain instances. And I agree with them theoretically. For instance, when do you do valuation? When there's a regulatory demand. When do you do valuation? When there's shareholders disputes. When do you do valuation? Maybe there's a tax demand. When do you do valuation? Maybe there's a merger or an acquisition. A company wants to take you up. Okay? Or when there's a succession. Now, but nobody looks at the point of strategic planning. If you are planning strategically, if you're an organization that has the plan of becoming the big, of growing, of getting to whatever the vision is, then automatically one major concept is understanding or going for the process of valuation. Now, let me break that question very well. You said why and when. Now, the when is what I want to, we are talking about closing the gaps here. The when is what I want to bring in. Now, because valuation can be done by both your internal staff, who are professional accountants, chartered accountants, or external valuers that you bring in, you can do valuation as often as you feel. Like I said, you are building up a model. In today's world of IT, digital world, data analytics, and every other thing, you need to build up a model. You don't have to wait until, there's a succession. One shareholder wants to leave, and because of that, we need to do valuation today. No. So valuation is a whole process. So when you do it as frequent as you have, build up a model. And what model are you building? Try to understand the factors that drive the value of your business. Okay, of which said a lot of people come to, based on the kind of job I do, a lot of people come to me, funny enough, a school, And the person says, I want to know my value. That was shocking. You want to know your value, and that shows a new idea. As professional accountants, these entrepreneurs who we are part of really want to understand what drives value. How can they attach monetary values to those factors that drive value? So in terms of when you do valuation, as frequent as possible. Why do you do valuation? Number one, valuation helps you understand the quantitative and the qualitative factors that drive value. Okay, most of the times, these guys are much concerned with the financial. So we, as experts, as professional accountants, will now introduce them into the qualitative aspects, which they may not be looking into. Number two, it's a major ground, a major foundation, a major thing to look at when making strategic plans. Valuation is key when making. Now, number three, why do we value a business? We value a business in cases like I've listed. When there's a succession, there are issues, so many problems. You agree with me? When people want to divest from a business, when shareholders say we are not doing, a partner say I'm leaving, and you realize that determining the value becomes an issue. So my advice is, if you have internal staff, start valuation, build the model now, so that when such issues come up, it is easier to round up the model. So when, as frequent as possible, why, the reasons cannot be limited. Thank you very much, sir.
Thank you very much for that insightful opening, even for us to know when and the reason for actually doing valuation. But for more understanding to our viewers and our listeners, can you please throw more light on the differences between a large company and an SMEs?
Okay, like I initially started with, for large companies, we're looking at companies that have more than, let me use the BOI classification, 200 employees. Okay, we're looking at companies that may even be listed. Now, when you look at such companies already have a value based on the trading market price. Such companies have information you can rely on. Okay, I've been privileged to be called upon to prepare a business plan for a business that has no records. No records. And funny enough, when trying to put the incomplete records together, this is a business that makes close to 4-5 million. But there were no records. They didn't see the essence of it. You get that issue. So when, as professional accountants, when we are called upon to do valuation for small companies, I don't want us to be driven by trying to get the figure, but trying to make them understand the value drivers in this business and how it transmits into figures. So basically, for me, large businesses are businesses that have, for me, based on the context we are discussing valuation, are businesses whose values can easily be measured. Businesses whose values can easily be measured because they have information, they have experience, they have data, they even have the skilled personnel to do it. While small businesses are businesses that may not even have information. Like I said, somebody with a salon says, I just want to know my value. An audit firm says, I want to know my value. So small companies are companies who may not have the staff, the skill, and the information even required for this valuation, which basically is a challenge. Thank you.
Very interesting. Very interesting there, Mr. Uchenna Ejiofor. Something rang like a bell in my head when you were answering Cheson's one of the questions he posed to you. A lady or a gentleman approached you and said, I have a school. I want to know the value of school. So let me shift my paradigm, therefore. So a pastor and imam could approach any of us as professionals. What is the value of my church? What is the value of my mosque? Perhaps what is the value of my shrine? And so that helps us to look at the what and the who. I want us to come back a little bit and dot the I's and cross the T's and ask that as a professional, what should a valuer look at when valuing an SME?
Thank you very much. Thank you for bringing me back to that. Okay, now when valuing as a professional, the first thing I tell myself, I've learned through the hard way of valuation. My first experience in valuation, I just felt it was normal. ICAN has trained us about projections and all that. Okay, so the first thing a valuer should understand, you cannot value a business you don't understand. So the first thing is understanding the business. Okay, and that makes you a support person. So the first thing is understanding the business. Okay, now once you understand the business, the next issue now goes on: who is valuing? That is you, or who the professional is. What am I valuing? Why am I saying this? There are different definitions for value. Is it the market value? Is it the fair value? Is it the enterprise value? What am I valuing? You need to be able to specify what are you valuing. Okay. Now, the next issue is, how do I go about the valuation? How do I go about the valuation? So, in real sense, when you want to value, the first thing is, what am I valuing? A business. What kind of business? Okay. Who is asking for the valuation? Why are we asking? Why are we valuing? Are we valuing because we're doing a strategic plan? Are we valuing because the business is getting liquidated? Are we valuing because we want to sell? Are we valuing because we're going to use it as a collateral? Are we valuing? So for me, the factors to consider are the what's, the why, the how, the where, the who is valuing, because all these factors affect the value you're going to get. For instance, if I'm going to sell, my valuation will be focused on getting the highest value. If I'm going to buy, my valuation will be on getting the lowest value. So in valuing, you need to consider these big factors. What are you valuing? Who are you valuing? But now let me not deviate. Let me go back to principles, static principles, that says there are 5 major things you need to consider when valuing a business. They call them specific considerations. Okay. Number 1 is ownership structure. The first thing you consider is ownership structure. Is it a sole proprietorship? Is it a partnership? Is it a private limited company? Is it even a listed company? Okay. Is it a cooperative? So the first thing is ownership structure. That's the first specific consideration when valuing a business. Now, number 2 factor is the business information. The people you're going to value the business are expected to give you some information. Like I said, you can't value what you don't understand. Okay, so they are supposed to give you some information. Okay, what data is available? What financial record is available? What information can they give to me? What do I need to know about the industry? Because you're going to evaluate all these issues. So that's number 2 factor you need to understand or look or consider when valuing a business. The third factor is now the industry, or what we call the economic characteristics. Okay, so number 1, I've been able to understand the ownership structure. Number 2, I've been able to understand what they are telling me, what the business information is. Now I'm not looking at the industry, the sensitivity of the industry to government policies and all that, what kind of industry. So that's number 3 factor you need to consider. What kind of risk, what kind of performance metric do they use in this industry? Is valuation a common thing in this industry? Do we have comparable businesses? How many small and medium scale businesses are in this, or is it a new sector? That's number 3. Okay. Now, number 4 factor you need to consider when looking at valuation as a professional is now the assets. Now, remember, we have operating assets and non-operating assets. So you need to consider when valuing what assets are operating. That means assets that assist you in generating income, and what assets are idle or not operating. Because all these factors are going to affect your valuation. Okay. And lastly, you have to look at the financing, which we refer to as the capital structure of that organization. So these are 5 main issues. I will go again. Number 1, because of the audience, you need to look at the ownership structure. Now, when we say ownership structure, you want to know that there is a shareholder agreement, the memorandum articles of association. Are there some regulations that restrict transfer of ownership? These things are going to affect your valuation. So you need all documents as regards the ownership of that business. Okay. Then number 2, you need now to get their information, the business information. What do they do? How many locations do they have? What kind of business? The business could be complex, and these things begin to define the risk. And those are the things that drive value. Okay. So you need to get the business information. What generates cash? What are the cash flow points? What are the sources? So they give you their own information. Then you throw this information to the third factor you want to consider, which is the industry. You begin to look at that industry. Are there other companies that have been valued in this industry? What's the market trend? What's the trend, industry trend? What's the competition in that industry like? Or what position are they in that industry? What are the performance metrics here? This helps you, and how is it done in this industry? Okay. And then we move to the 4th one, where you need to now begin to share the assets into what are the operating assets and the non-operating assets, okay, in that business, so that you know how it's going to come into valuation. I'm going to throw more light on that as we look into valuation proper. And lastly, very key, the financing. Is it by equity? Is it by debt? Are there going to be some funny, unusual sources of finance? How am I going to bring them into my valuation? So these are 5 specifics that guide you in valuation. But don't forget what I said from the beginning. Ask yourself, why am I valuing? Who is valuing? What are we valuing? Why are they valuing? On what purpose? Where are we valuing? And all those issues. This will help you come up with a good valuation result. Thank you very much.
Thank you very much, Mr. Ejiofor, for that wonderful and insightive into the question of what the valuers should look at. But looking at some of the explanation you've given, the 5 critical things that you look, this seems to be subjective to me of an individual just doing it the way they want. And it prompts me to this question. When you talk about valuation, do we have standards that guides valuation, just like we have IFRS for our financial reporting?
Wow. Thank you. I think this is a major problem. Thank you very much. I think this is a major problem. Why do I say a major problem? I've been privileged to review valuation reports, and I realized that most people do it the way we like I started with. When somebody came to me and said he wants valuation, I was like, wow, I did business valuation in SFM. And what's there? I bought my textbooks and I was able to come up with something, package it. I will want to say here to my colleagues, the audience generally, to owners of businesses here, there are standards that help us in valuation. They are known as the International Valuation Standards. International Valuation Standards, IVS. These standards are divided into 2 pure groups. And we have what we call the general standards, and we have what we call the asset standards. We have what we call the general standards and the asset standards. Now, the general standards are supposed to be applicable to all kinds of valuation, irrespective of what you want to value. Like I said before, valuation is a science, meaning these standards give us a guiding principle. But the art is how we apply these standards to the different scenarios that we see ourselves in. So when you don't follow these standards, I bet you in this global world, you prepare a report that when it's sent to a reviewer, the person, he doesn't meet the standard. Because one of the issues the standard says is if a professional prepares a report, the standard to check if that report meets standard is another expert, valuation expert, should be able to interpret your report without reference to you based on the report you have presented. So it doesn't matter how you've done it. If you've done your report and an average rational professional cannot interpret, cannot understand your report, it simply means that that report does not meet global benchmark based on the IVS. So if I want to go back, valuation is defined as determining the value of a company based on principles compliant with the IVS. Meaning that no matter how good you do it, if it doesn't comply with the IVS, somebody may reject your report on the basis that, look, there is really no guideline. You've just done what any other person can do or should do. We are professionals and we are guided. So valuation is guided by valuation standards, international valuation standards. Remember I said we have general and we also have the asset standards. Okay, for sake of time, I don't know if we have to go into what comes under the general standards and what comes under the asset standards. Thank you very much.
Yes, I think we should have a bit of a time. What should come under the general and what should come under specific, Mr. Ejiofor? Very briefly.
Thank you very much. Now, what comes under the general standards? Like I said, why are they called general standards? These are things you should follow in all valuation. Okay, now there are 5 under the general standards. IVS 101 talks about the scope of work. It is saying that if you are going for a valuation assignment, you must define your scope of work. Like I said, what am I valuing? What is the basis of valuation? What am I, it derives who is valuing. What is the date expected? Why are we valuing? The purpose of valuation. So it's trying to spell out everything, the limitations, likely limitations of valuation. So the scope of work is the first one. IVS 101 guides us on how to prepare a scope of work for valuation. That's IVS 101. So every valuation, you don't just jump and say value. If you say go and value a business, someone may say value my business, ignore the land. Someone may say value just the share price, ignore debt. So you need to define what you are valuing, and that's what IVS 101 is saying. IVS 101 is saying value, look at the scope of work. Now, IVS 102 says whenever you're going for an assignment, can you investigate? So he's talking about investigation and compliance. Okay, so what's that saying? Like I said, the second factor you consider was business information. This information they gave to you, you need to investigate. You need to justify. You need to be sure that you can rely on this information. For instance, they may give you audited accounts. You need to be sure that these opinions can be relied upon when doing your valuation. This sets disclaimers, this sets limitations, this sets on whether you even do the job or not. So IVS 102 is about investigation and compliance. Don't forget, step 1, IVS 101, scope of work. IVS 102, investigation and compliance. IVS 103 guides us on reporting. IVS 103 guides us on reporting. How do I report? So you don't prepare a valuation report and send a document that looks like a memo for a report, or a document that looks like an audited report. They are different. This valuation, there's a pattern, there's a way, and they differ for different industries. Information expected differ. So IVS 103 guides us on how the report should be prepared and what should be embedded in these reports. Okay, so IVS 104 now goes ahead to tell us about the issue of the basis of value, which is the fundamental premises on which we value businesses. So IVS 104 looks at what is the basis of value. Is it the fair value? Is it the liquidated value? Is it the synergistic value? So it tells us the basis, the premises on which we value. And then IVS 105 talks about the approaches to valuation. The different approaches. We have the market approach, we have the cost approach, and we have the income approach. So these are general standards every valuation process is expected to follow. Large business, small business, very, it helps you. Scope of work, investigation and compliance, IVS 103, the reporting, IVS 104, what's the basis of value, which now determines the methods and the approaches you will use in IVS 105. So those are general standards. Now, asset standards is now looking at specific, we call them specific standards, asset standards. For instance, our focus today is business. So we'll be looking at IVS 200, which looks at business and business interests. Okay, now we may also want to move to IVS 210, which is looking at intangible assets, and like that. So many standards. We have for real property, we have for inventory, we have for, and like that. So there are 8 standards in the asset standard, if I'm not mistaken, and then 5 standards in the general standard. Take note, general standard is for all valuation, then the asset standard are specific standard depending on what you want to value. Now, because today's focus is on business, I'll be looking at IVS 200. Thank you very much.
Super analysis, super enunciation there. If you are just joining us online, this is ICAN on Air. You're broaching the subject, approaches to SME and entrepreneurship businesses, valuation by professional accountants, and how to close the gaps. I come to you again. By the time I come back to you on this, let me also quickly let our online participants know. Please send your questions. Mr. Uche Naijo will attend to them. Now, I want to now assume that my knowledge of grammar and my knowledge of terminologies are low. And I'll give you a background into why I want to go this way. Recently, there was something that happened that we had our brothers from the north, and they were going to make some donation to a cause, and the cause is cause of a school. And this gentleman came up and donated some whooping 63 million. Background: he was not articulate in English. He could not in any way communicate, but he had the wherewithal. The only thing he said was, well, I do business between Kano and Ibadan. I travel from Kano, I come to Ibadan, and I return, which we will call turnover. And I make sure that I try my possible best to go by the best of means. And you have talked about those 5 characteristics: ownership structure, business information, industries through economic factors, assets, which will be the operating and non-operating, finance and capital structure. I'm going back to this, my example. You want to ask this man, in what way is he going to be able to give you all this kind of information? Apart from what you described, I think I agree with that, incomplete records. And so he may not be able to communicate. I want to look at the approaches available for valuation, which you have clearly stated here. And now ask, as in the example of what I've just given, what specific approaches are suitable for SMEs? Or the example of the man who but was able, at least beyond expectation, able to donate 63 whooping million. What approaches are suitable for such SMEs or one man of that nature? What approaches will you recommend?
Okay, the approaches you recommend, when it comes to valuation of SMEs, like I said, based on IVS 105, there are 3 basic approaches there. Now, but what determines these approaches is always the purpose of the valuation. That's the issue about it. For instance, the man you have talked about, and forgive me to go back to your story now. Let me assume I walk to that man and I say, oh, you want to value your business. Can I have your records? He says he doesn't have any records. Okay. Now, what kind of business do you do? He says he travels between Kanu and Ibadan. Now, what you realize is you can't even use the market price or market approach because there won't even be any comparable business. Now, the easiest approach we go for is usually the income approach. The easiest approach we go for is usually the income approach, which is what everybody goes for. But that approach is not as easy or as simple as people make it to be. So the first thing is sitting down with this man and understanding, number one, sir, what really drives your income? What really drives your income? Okay, so you want to understand his income. You want to understand what he does. Now, when you sit down as a professional, which is the gift we have as professional, you will begin to understand the likely value drivers in this business. Maybe the man has easy access to finance. Maybe the man, it is about his brand. Maybe it is him, his person, his reputation as a person. So these are the things that form values. These are the things that, that you are going to put together in trying to, extract or build up a forecast or a cash flow business for that guy. Now, let me throw a little light on income approach. When we say income approach, there are various methods. Now, the standard also helps us understand one thing that we should ask. We should ask this man, when did you start your business? How many years? Can we look back at 1, 2, 3, 4 years, 5 years? The man may tell you, I just started business. I just started 2, 3 businesses. So I will just use a summary and then relate the man. Income approach says you can use whatever method under the income approach, whatever method. But don't forget, like I've said, whether you are going to use the income approach, there are so many questions you will need to have asked this man, like the financing, the ownership, and all that. So I would have asked the man, I want to assume it's a sole proprietorship business. So your shares are just you. I would have asked the man information about the business. What do you sell? Who buys? What is your customer base like? Is it just one person that is buying from you, a Dangote, that once he stops, your business closes? Don't forget, when we say estimate of value, we are looking at the future value of this business. So the income approach says, number one, you should be able to establish the historical cash flow of this business, the historical income of this business. Okay? You should be able to bring out what the historical is. If we cannot, then we may just go for the net assets approach, whereby we just do the normal assets, less liabilities. That also brings a problem because this man has reputation, which is intangible assets. So how do we value the intangible assets? We'll have to run back to the standard again to ask, based on the IPS, how do we value intangible assets? So where I'm going is, whatever method you want to use, in general for SMEs, it is always advisable. Always advisable. And let me use the Nigerian context. In Nigeria, we've seen that most of our businesses are sole proprietorship, which means we have people, we have businesses whose records may not be too heavy to rely upon or too accurate to rely upon. So the best method to look out for is the income method. But there's a clause in the standard that says you cannot use one method when there is a but to that method. If somebody does not have sufficient records or income for me to, or cash flows for me to rely on, then me relying on the cash flow is subjective. So what do? I will have to use as many approaches as possible and then try to allocate them, weight them in determining what the value of this business is. So for this man's business, number one is I will use the income approach. Then I will also use what we call the multiple analysis approach. Okay, I'll use what's the multiple analysis approach? I'll look at the industry where the man is and try to get an average value of the likely income that businesses in that sector earn. And I also look at, okay, what's the likely multiple and risk that are associated with these businesses, and then try to determine what the man's value will be. So like I said, when you're valuing small and medium scale businesses, the challenge about it is, number one, understanding that business, understanding why the person wants to value, picking out those value drivers in the business, and then understanding the major issues, which is the risk associated with that business, and then you can determine the value. So most times, based on your question, people run to the approaches, but those approaches are dependent on information available. Those approaches are dependent on the whys, the what, and the where. So if you don't look at those things, you will have a problem valuing SMEs. So don't forget, like I said, in valuation, there are three basic approaches. Income. Market is usually very difficult for small, using the Nigerian sector. Market businesses, because it's very difficult to see, we have 55% of our businesses in wholesale and retail. We sell different things. So for me, it's the income-based method, whereby, as usual, use the assets to get the lowest, use the income, and then automatically use the multiple analysis method.
Great. Geoffrey. In fact, you are actually breaking down this valuation, and I want to believe that our listeners are actually benefiting. But before I pick my own question, let me quickly recognize Zionic Obuwe. There was a question he flagged because they are the reason why we are here too. Obuwe actually wants to know, before I come to Ajibade, that what aspect of accounting handles valuation of business?
Corporate finance. If I get this question, when you say what aspect of accounting, is actually corporate finance that handles valuation of businesses. Corporate finance.
Okay, that's great. I'm sure Buwe got that question. Let me quickly pick Samson Ajibade is asking you that how do you know if a building has been overvalued or undervalued, since 2 or 3 valuers cannot get exact value? How do you ascertain that?
Okay, and the first question I will, because of time, is when you're looking at the issue of overvaluation or undervaluation, it's subjective. Who says it's overvalued? Who says it's undervalued? And that's why the standard says you cannot use average value. You allocate values based on which value, which method, which approach has more factors to give you a more accurate value. For instance, like he said, using the building issue, if I have 3 methods I'm using to value a building, the most accurate method will be the price, the likely price of that building. So if I have a similar business building in that area, that will be the closest. But because the two businesses are not the same, I will give that like a 70%, and then use income and then use costs, the cost of either the reproduction cost or the replicating cost or the summation cost. So when I look at those 3 methods, I can also, okay, because I'm sure of the price, of the price method, the market method I use, let me give it 60%. Okay, now because I'm not too sure about the other 2 methods, I'll give them 20%. So you cannot just come and say average of the 3. No, the standard does not allow that. So you allocate to them. And like I said, if I want to sell, you saying overvaluing, you're on your own. There's no overvaluation if I'm selling. If I want to buy, that's when I'll be looking at. So the issue of overvaluation and undervaluation is highly subjective on the basis or the purpose of the valuation.
Thank you very much. Let me quickly take this. You seem very versed and well experienced on this topic. And I just want to ask you, what are the challenges in valuation, both from the client side and the professional?
Well, I think the audience, thank you very much for this question. In fact, I am I'm thrilled at the wonderful questions that are coming both from my wonderful anchors here and the audience. Now, from the point of view of the valuer, the major challenge we have for small and medium scale businesses is number one, getting the information. Number two, transforming the intangible issues, the risk, and the intangible issues into monetary. How do I incorporate risk when building up a discount rate? How do I incorporate risk when getting the cash flows? It's a whole, if I take the income approach, you see that everything in the income approach, using the discounted cash flow, it will take a whole day trying to analyze each of them. So the challenge is, number one, understanding the business, getting the information required from a small and medium scale business is not easy. Then doing the forecast, those assumptions, and then how do you measure risk and bring them into your discount rate? Those are the major challenges you get from the professional's point of view. Okay, but my advice is, when you understand the business, when you understand the industry, when you understand the performance metrics of those industries, you'll be able to take care of these challenges. From the client point of view, my advice is, get a finance advisor. Let me use the word financial advisor here. If you don't have enough funds to employ a chartered accountant, so that you already have a model of valuation. When you have a model of valuation, it is easy. Number one, information will be available. Okay. And number two, it's easy to attach values to these issues. So those challenges I'm taking care of.
Super, Mr. Uchenna Ejiofor and Mr. Abiodun Imiere asked this just very briefly, that all the three approaches, income, net assets, and multiples, should be used to value all small businesses.
Like I said, not all. We need to understand this. Okay. If you can rely on the income of a business, you can rely with certainty to your assumptions, you can use one method. Okay. But remember, you are dealing with a buyer-seller issue. The buyer does his valuation. You don't want the seller, the advisor to the seller, or the advisory person to the seller to come and rubbish your valuations. That's the essence of trying to check. So when there are large variances between your valuations, you want to reconcile.
Super. Thank you. And because time has always been a challenge here, we've seen the gaps, we've talked about the challenges, information, which should be knowledge is key. I'd like to ask you, what is ICAN's role in closing these gaps that you have eminently and beautifully identified in the valuation profession?
I think theoretically, number one thing ICAN has done is introducing the international valuation standards to their syllabus. That is one good thing ICAN has done. Because one challenge you have with students is reconciling theory with the practice. So that valuation standards, I would advise that the exam body test a lot on it, so students get to. So that's one good thing ICAN has done from the student perspective. And then from us as members, what ICAN has done is the corporate finance faculty is also doing a lot of trainings. And I believe valuations has also always been part of those trainings and MCBs that have been coming out. So ICAN is doing a lot. They can still do more. Thank you very much.
Super. And because of that continuous education, the profession has been at the forefront of ensuring that cutting-edge technology, cutting-edge areas of entrepreneurship continues to be a focal point for us as a group. And so, quickly, Mr. Ejiofor, what will be your last word on this subject as we round up?
Oh, because of time,
yes.
Permit me to say thank you very much for this privilege. I was introduced to ICAN on Air, I think 1 to 2 months now, and I kept wondering, how do you pick the speakers? How do you pick the topics? It has been I need to thank the institute. I need to thank you, my anchors, and our president. I would need to thank the president of the Institute of Chartered Accountants for this serious boost to knowledge. I want to advise students, colleagues, and anyone who is watching now. You just don't want to miss. What I do every week is at least go back and look at one of these topics, and that has really been a blessing to me. And I believe anyone who connects to this will really be enlightened, as the name is ICAN on Air. It's really an enlightenment show. More grace to you.
Thank you very much, Mr. Uchenna, for. I'd like to also thank our online participants for throwing in the questions that has enriched this program. Mr. Uchenna, be sure that we are going to come back to you, because our students are jeering to learn more and to put Nigeria on the forefront of the map of serious interrogation that can be done by a professional institute. A few announcements talking about entrepreneurship. The Institute of Chartered Accountants of Nigeria Entrepreneurship Development Center, ICAN EDC for short, has started its practical session from March. Should be starting the practical session from March 21st, 2022 at the Entrepreneurship Development Center, the ICAN Center at Abu Odofi. While we wish the very best to our participants at the IBWA conference going on in Monrovia, of course, as usual, you should expect that Nigeria will continue to chalk and chalk and chalk. And you could see some of the pictures that have been coming to us. The president of the Republic of Liberia has been grinning virtually from ear to ear with the value that our members, Nigerians, are bringing to the profession. I say kudos on to that. I like to also say that the next episode of ICAN on Air, which we have churn out on a regular basis, is going to take place on Tuesday, March 22nd, 2022. Time will be 6 p.m. West African time, and the venue, of course, will be all ICAN online channels. Please want to tell somebody else to come and be part of this cutting edge that the Institute of Chartered Accountants of Nigeria is giving to Nigeria. And the topic we are going to be looking at will be the relevance of professional accountants in today's environment. And guesting with us will be Mr. Uyi Akpata, FCA. Mr. Uyi Akpata is the senior partner for PwC Nigeria and the regional senior partner for PwC West Africa. Over the years, Mr. Uyi Akpata has worked to significantly enhance the standards and practice of accounting in Nigeria and contributed to shaping the Nigerian economy as a trusted advisor to many top businesses across various levels. He also contributes significantly to community through various causes and initiatives. He was recently awarded a honorary doctorate degree in management science by the Wellspring University in Benin City, Nigeria. He was the past president of the Cricket Association of Nigeria. You do not want to miss this. Please don't come alone. Tell somebody to be a part of this. And so, as we begin to round off, may I ask my co-anchor, Sheson Okunade, to very briefly give us a bye message.
It's been a wonderful time today with you, Mr. Akinfatoke, and to our guest, Mr. Ejiofor, who has done justice to our topic. And I want to believe that our listeners also have gained a lot and have seen another niche that they need to create for themselves. One thing I just want to encourage each and every one of us, always make it a date every Tuesdays and Thursdays, just like the anchor said. Next week, Tuesday is another time. You will want to meet the interesting discussion with Mr. Uyi Akpata. It's going to be an interesting time. So see you next week, Tuesday, same time, connected on the same platform. Bye for now.
And thank you very much, Mr. Sheson Kwade. And may I leave our online participants with this short quotation. Do not be embarrassed by your failures. Learn from them and start again. That is attributable to Richard Branson, the founder of Virgin. And like I always say, be the change that you always like to see. And so the sun sets on ICAN on Air at this point, to rise again on Tuesday, March 22nd, 2002. And until then, I remain Akin Fatunke, your anchor, ICAN on Air. Bye for now.